Hello everyone, and thanks for tuning into the Financial Investor channel. Today we're going to be covering my strategy of investing in dividend stocks. So before on my website, I did have my strategy on there. It was sort of a brain dump that I had did. I went over a bunch of rules or sort of questions that I asked myself and had just sort of stuck it on my website. But I went through there recently, reviewed everything that I had on there, updated it, made it a little bit clearer to read. I put my three questions that I ask myself when I'm investing in a company, and then I have 7 rules that that I like to follow. 5 of which are sort of core rules, and then I have 2 that I try and avoid if possible. But there are stocks out there that I'm invested in that I do have 2 rules on there that I don't always follow because I think that in the long term, some of the stocks that I am invested in, they are well worth what they're priced at right now, and going into the future, they will be worth more. So essentially, this is the financial investor strategy to stop losing money in the long term. So I'm sharing my strategy for investing, and if followed, will present a great opportunity to collect income and grow your wealth semi-safely as you can in the stock market. So of course, if you are brand new to my channel, I do make stock market, financial, dividend related videos and all sorts of other ones I try to make. And of course, if you are brand new, go ahead and hit the subscribe button, hit the notification button for all my releases coming out. I release a video couple days, 1 or 2 days in between. So, 3 questions I like to ask myself. Question number 1: is the company recession proof? Now, what does that mean? Did the company stop, decrease, or discontinue dividend payments or growth during the last recession? Now, in this example, I could bring up I have Verizon and AT&T. Verizon cut their dividend back in 2005 through 2007, whereas AT&T has had dividend growth for 44 years. So we can go over here to dividend.com, punch in VC. Right off the bat, we can see that they had dividend growth since 2007. You come down here towards the bottom and you move this right around 2007. We're going a little bit 7 here. And if we open this up a little bit, you can see that they cut back. They had a little increase to 41 cents here in March 2005. Then they didn't increase it until 2007, June 7th. And that was the last time they paid 41 cents. Then they bumped it up to 43 cents. So Verizon, they're semi-recession proof. They didn't exactly cut back their dividend, which is what some companies did. GE, or I think GE cut their dividend back. They didn't cut it back, but they just didn't grow it. Whereas if you chose AT&T here, so let's punch in T, they've had dividend growth for 32 years since 1985. So quite a while. So difference there. Question number 2: will the product or services offered be needed in 20 years? Now, in this example, I used Disney and Six Flags. One of these companies has a variety of products, services. They have media outlets. They have franchises such as Star Wars. They have theme parks. They have a variety of different products and services. Whereas one of these, Six Flags, is mainly just theme parks and had actually filed for bankruptcy back in 2009 after they had fallen $2.5 billion in debt. So that is question number 2. Will the product be needed in 20 years? Question number 3: how is the industry barrier? Is it easy for another company to create the product or service that you are investing in? So in this example, I used major airlines. How difficult is it for someone to pop up and compete with American Airlines, Delta, what's the other one? Those are some of the huge ones. Delta themselves. I've been looking to buy into Delta, and that's why I kind of use it as an example. It's very hard to get into a major airline. You have to first build the aircrafts, which that takes a lot of money. You have to have the area to build the aircrafts. You have to pay for maintenance. You have to pay for workers and your pilots, and that's just a huge startup cost. And what are some industries that are very easy to get into? Camera building. How easy is it for someone to just sort of it's not Alibaba, but there's another website that I don't know if it's I don't have it. It's similar to Alibaba. You can go on there and buy Chinese knockoffs and then resell them on Amazon. And sometimes they're similar to Alibaba, but you can sometimes mark it up by like $5, sell the same product. Like, say, a GoPro is selling for $400, whereas this Chinese knockoff that still does 4K, you could actually sell it for $80, marking it off below, the higher products. Just like you see at Walmart and stuff, they have nice shoes and then they have terrible shoes. Some people don't want to pay for those premium items, but they'll pay for a knockoff of a premium item that still works essentially the same way. So it's not a very hard niche to go into. So those are my 3 questions that I like to ask myself when I'm even looking at a stock. So a lot of my stocks here, just in AbbVie pharmaceutical company, for the long term, it's very difficult for brand new pharmaceutical companies or biopharmaceutical companies to come in and start getting patents made for them. You don't see a lot of that. ADP, their only other competition is really Paychex. They're both human resource companies. Colgate, they're a consumer. Cisco is one of the best in technology for networking tools. I forget what the other brands are, but I use Cisco all day at work. Router switches, ICE, a whole bunch of other products. I can't really think of all of them off the hand, but we use quite a bit of them. So Cisco I'm very familiar with. Costco's huge. It's retail, but it's member focused. They have a lot of loyalty and they build that loyalty with their customers, so their members are willing to come back, pay for that card, and shop at their stores because they offer prices that are very competitive pricing. CenturyLink, that's one that's in my stock. That's not really following my rules. I thought it was a great buying opportunity, and that one's actually looking, who knows what's going to go on with that one. Ford, Intel, Lowe's, Microsoft, Pepsi, Pfizer, AT&T, Verizon, Exxon, these are just all great stocks. So I've asked myself on all 3, all the stocks that I've held, they all go through my 3 questions. Now on to my actual strategy of investing. Once I've looked at a stock and it's kind of hit it on the head with my questions, I go into my rules. So my number 1 rule is stock must pay a dividend. As a dividend investor, I am looking for stocks that pay a dividend. I would also like to have I look for the best buying opportunity when the yield is sitting higher than its 1-year average. So as an example, I bought AbbVie back in August. So if we take a look at the price and the yield 1 year ago, back in August, the yield had been sitting down on AbbVie for a long time here. You can see for many months prior to the election even that the yield was greatly outweighing the price. Now I invested in AbbVie back in August, and they had a leukemia, I think it was, that drove their price up gigantic. I'm over 30% now in AbbVie. It's a great stock, biopharmaceutical. This is the chance that I'm looking for, where the yield greatly outweighs the price, and I jump in and I see some news coming up for them and I ride it up. Same with Exxon. Exxon had a huge yield back in August timeframe. I bought in the dip and continue to hold it. And Hurricane Harvey, they got hit a little bit, but they've done very well, and they're still semi undervalued. We'll actually hit another, we'll talk about this one here in just a minute. But rule number 2, it's got to have a dividend, got to have a good buying opportunity. Dividend stocks are defensive stocks by nature and prevents the stock price from falling too much even during bearish markets. So investors that are in a stock for the long term are more willing, they're not as eager to pull their money from these dividend stocks, from these blue chip companies that have year after year increased their dividend, continue to pay out their dividend even during times of recession. So that is my rule there. Rule number 2, I look for low price to earnings ratios, normally under historical averages, which is currently at 26. So here, if I clicked on the historical, I got hiccups now. hiccups. The historical average right now is sitting at 25.87. It actually moved up 4 cents today. So I rounded that up to 26 as a price to earnings ratio that I like to buy underneath. A lot of my stocks that are well underneath 26 price to earnings ratio. So a low price to earnings ratio suggests that the company is trading below its value, making it cheap. It's not always the case, but I believe for the most part that is true. So Lowe's price PE, actually if I just look up Lowe's stock, that was not what I was looking for. Google normally gives me, let's just look up Apple. That's a better Apple stock. I don't know why the other one's not showing me, but here price to earnings for Apple is 19.18. A couple months ago they were sitting right in that 14-15 area, so they've definitely moved up quite a bit, but they're still well under that 26 historical average or current average at this time. Now, the rule number 3, I like to invest in companies with a low payout ratio, at least 60% or under, unless it's a follow into a different category where they need to pay over a certain percentage of their earnings in order to be taxed differently. So a payout ratio is the percent of earnings needed to support the dividend. So this is a very important key. How much of the dividend is being paid out to the shareholders versus how much of their earnings are being reinvested into their company. 60% and under means that if the company's earnings did fall by, say, half, as an example, if their earnings fall by half, a 60% ratio may bump up to 80%, but it would still be able to cover the dividend until they could recover their earnings. So in this example, you can see here, AT&T does have a very high earnings, but that is pretty normal in all the telecommunications industries. It's under 60, it's over 60% payout ratio, and that's completely fine. Whereas if we look at AbbVie, their payout ratio is under 52. If we look at Exxon, their payout ratio is actually pretty high. They're a oil and gas industry, so I won't hold that against them. What's another one here? Cisco. Let's go take a quick stab at Cisco. 53.2. So that is that one. Now, rule number 4, history of growing dividends at least a 5-year minimum. Dividend growth of at least 5% or higher. Now, consistent dividends always indicate a healthy business. If they're able to grow their dividends year after year, as an indicator of a healthy business, their earnings are increasing, they're able to increase their dividends a little bit at a time. The company is generating cash and wants to say thank you to their shareholders, and they do that by paying out that dividend. So that one's pretty normal. I mean, you saw it on here, dividend growth of at least over 5 years. Cisco has been paying out dividends since 2011, and I believe that's when they actually started paying out dividends, and they've been kind of paying out dividends since then. Now, rule number 5, they must have a strong balance sheet. I look at 3 to 5 year and kind of look at that. I wrote 3 here. I probably meant more close to 5. I like to say that in the past 5 years, they've had some sort of an increase in their revenue, their free cash flow, their net income. I don't always hold it against them. I try not to. Positive revenue, free cash flow, net income, they're all important for the long-term investing, that they can continue to pay out that dividend in the future. If they fall back on their revenue, they have free cash flow to be able to pay out that dividend, and their net income, it could or could not be, it's important. So as an example here, if we bump over to fundamentals here and we look at what are we looking at? Exxon. Let's take out their dividend yield, take out their price, we bump in their revenue, free cash flow, and net income for 5 years, and we add percentages in there. Exxon's actually gone down quite a bit here in revenue, free cash flow, and net income. Whereas AbbVie, they've gone up in net income by 12.85, they've gone up in free cash flow 40.65, and they've gone up in revenue by 48.38. I believe Microsoft is always in the same boat as well. Let's take out Microsoft, or take out AbbVie, bump in Microsoft there. Microsoft, they must have spent a lot of money on Azure, because they had big dip in their income there. Actually, that's their income. So when did they release 2010? I'm not sure. They haven't made a lot of sales off of that, I'm sure. But either way, they are recovering from the hit back in 2015, 16, and they've been kind of moving upwards now to become positive in their net income. So that is rule number 5. Rule number 6. These are rule number 6 and 7 are sort of avoid if possible. But of course, if a stock is looking at it like it's a great buy. Okay, so rule number 6, avoid if possible stocks trading for a price to book value ratio higher than 3. A low price to book value suggests that the company is undervalued and could be getting a great company at a discount. So in this example, let's take a look still at Exxon and take out their revenue, net income, and cash flow. Let's take a look at their book value and take a look at it just in base form. So since here they've been moving down in price to book value, so their price of their stock has actually been in the range of below 3.0. So 1.1 ratio would mean that their stock price is currently trading at their book value of their actual company. If you took all of their assets, put it together, and there's a whole calculation, I can't think of it off the top of my head, but just essentially what the book value of the actual company is, it would be essentially if you're buying the stock, you're paying 194% premium. If you're paying 100%, you're paying 100% of the price for 100% of the company. If you're paying 194%, you're just paying 94% extra for that price. Whereas Microsoft, they do have a bit higher of a price to book value, 7.2. But long term, do you see Microsoft going anywhere in the next 10, 20, 30 years? No. Microsoft, Office, Windows, all sorts of other products out there. Their cloud business it's been exploding, and I don't see Microsoft going anywhere. AbbVie, let's see what AbbVie's is, 22.85. That's pretty high. Their price to book value, their price of their stock, it's currently 228%, or just what is that? 128%. You're basically almost paying double for their current price to what their book value is of their company. And that's that one. So rule number 7, avoid if possible stocks trading at a price. Avoid if possible stocks trading for a price to sales ratio higher than 3. Well-established businesses with reliable sales can command a ratio higher than 3. In the private market, in the private markets, companies often get bought and sold at prices between 1 to 2 times sales. So back over here, if we look at price to sales, PS ratio, we can see that AbbVie has a 5.6, so it's a very well-known company. They have a lot. Their price to actual sales is a little bit high, but they're very well-known. Whereas Exxon price, let's see, is that the same as the price to book? It's slightly under. So 1.39. Microsoft 7.0. If we put AT&T in here, that's a 1.2. If we put Verizon in here, it's a 1.4. If we put ADP in here, they're at a 4.0. So they have the price of the stock is a little bit higher than their sales, but it's not too bad. These are avoid if possible to kind of get you that value buy, but there are some stocks out there that you can see them for the future, that their price is actually worth or will be worth more than what it's currently at in the future. So those are my 3 questions that I like to ask myself and my 7 rules of investing. So hopefully that's been informative. If you have enjoyed the video, go ahead and hit the like button below. If you are brand new to my channel, go ahead and hit the subscribe button. Hit the little ring, the notification thing, to be notified of all my weekly updates. And of course, thank you guys for watching, and I hope you guys all have a great day. Have a good one. Bye-bye.